Very pleased to welcome back to the show now Ryan Irvine, Keystone Financial. You can find him at www.keystocks.com. Ryan, just before I get to the current market conditions, I got to talk about one thing, and that is that the World Outlook Conference, we've always worked together. You guys have done a fabulous job putting our small cap portfolio together, and I just want people to know. I was just checking on one of them, and I actually tweeted it out because XPEL, which is a NASDAQ stock, you recommended it this year's Outlook Conference. So what is that, 7 months ago, up 68 to 70% this year. So I'm giving you a pat in the back and saying, wow.
Thank you. It's great to be on once again. XPEL has done tremendously well, and not only just in the last 7 months. This is a stock we recommended to clients just 2 years ago in this September, and it was $1.42 then. It's up around 500% since that time. It's a company I can even get into an update today. It's the great thing about a business like that, it's really simple, really easy to understand, really great for us to analyze and dig into. And the stock is up 500%, but the profits are up fivefold over that period as well, just over a 2-year period. So, we haven't sold any shares. There are companies that, make returns like that or even half of that and will sell it because, they're trading at higher valuations. In this case, it's still trading at a market average multiple right now, despite the fact that it's gone up 500% in the last 2 years, and that really is impressive. It shows that we are able to buy that business at such a discount to what we would think its intrinsic value is, and it's rewarded our clients over that period, and hopefully rewarded some people who came to your Outlook conference there.
I'm sure they
and
did.
Have made a profit of that already.
Yeah, and many times. We've never failed. You guys have delivered double-digit returns every single year since we've announced it. 10 years ago now, Ryan. I don't want to make you feel old today, but 10 years ago, the first one, double digits every year, sometimes, close to triple digits there. So I just wanted to start with that because, as I say, a pat in the back. But I'm going to get back to that in a second. But first, let me just talk to you about today's market environment. Here we had another, tariff. The tariff war is alive and well. And we get more news yesterday, the Chinese slapping on tariffs, Trump retaliating, that kind of stuff. And my goodness, then you go down 650 points. As someone who looks at individual stocks, does that create a buying opportunity for you, or do you sit back and say, maybe not yet? What do you do with that kind of volatility that we've been experiencing over the last month, really directly related to those kind of news items?
Yeah, and I think it focuses us in on the individual businesses because it is a high level of volatility that we're seeing in the markets right now. So you always see noise around the stories that we're talking about, and they can, like you said, I think you brought up a good point there. Can you find opportunities when this happens? And yes, when you see the market sell off indiscriminately over some periods of time, 2 weeks, a day, it can happen. You can have some babies thrown out with the bathwater. And that's when we have a monitor list at all times that we're looking at great businesses that we want to be involved in, we want to invest in, but are they trading at reasonable prices? We need to be disciplined to buy those businesses at reasonable prices. So when you see some market volatility, you can perhaps, especially over the summer months in particular, when you see lighter volumes, you can see a stock pull back when nothing affecting that business has really happened. So there's nothing that has impacted the fundamental outlook for that business going forward, other than the fact that there is some noise in the market. Donald Trump's tweeting out something that has caused the market itself to go down. That stock goes down in sympathy with the market, so you can get it at a more reasonable price. We actually love to see scenarios like that where you can see a good business go on sale and we can take advantage of it. Often, it can be a stock that we've already recommended in the past that's gone up and maybe had a pullback. We can get new clients in on that stock at a discount when you see some volatility in the overall market, and that company comes down in sympathy when absolutely nothing has changed with the core cash-producing core of that business, and that those are things that can you can have some fear in the overall market, but they can certainly be an opportunity for us. And XPEL is a company that, like the example there that we gave, that ran up to as high as $7, then pulled back earlier this year. Nothing really fundamentally wrong with the business, but there was some volatility in the market, a little volatility in the company, and we were able to add it again at the $4.50 to $5 range, and now it's trading in the $8.55 range, and it was up 26% this week in one day in a market that was downtrending, and that's because the fundamentals of the business and the growth was there, and they announced a record quarter again. So the great thing is, in this market, you have that volatility, but you still see great businesses being rewarded with when they come out with their solid earnings. What would worry us would be if XPEL came out with those earnings this week and the stock did nothing, because then you are not getting rewarded for all that research that we put into this company, and the business should be rewarded when it comes out with record earnings like that. You're still seeing that, so that doesn't worry us. When we see good businesses get rewarded, then we'll take the volatility and take advantage of it.
And that brings me to something else, because I can remember talking to you about this, Scott, it's over a dozen years ago, and saying, how important it is to issue sell recommendations too, or hold, which you guys do. And that comes to a sell. I'm thinking about something like Zynex, which you talked about in this show going back a little bit. Remember, it was like $3 or something. It went up to like $9, but you sold it at that point. And let's talk a little bit about when you sell, if you think about going back in, that kind of stuff around selling.
Yeah, it's a great discipline. You need to know. It's easy sometimes to buy, but you need to know when to sell. Zynex is a company, symbol ZYXI on the NASDAQ. We actually, last time I was on the show in March, end of March, it was trading at $4.50. It had been up from our recommendation at $2.90. It was trading at very reasonable valuation still at that point. We recommended it again because of the fundamentals, traded at about 15 times earnings under the market, what it was trading at. Now, the stock shot up to over $9. At that point, it was trading around 25, 27 times earnings. Growth had slowed slightly, and there was something that the management had did. They listed their shares that were available for sell. The main CEO could sell the shares, essentially. It added a little bit of risk to the story. It was then trading at a premium to what the market multiple was on the average stock on the exchange. We had gained 200% over 18 months. It was time for us to take our position off the table, so we recommended to our clients at that point to sell. And if we see the company trading at we like the business, we still like Zynex's business, but if we think it's priced at a premium to the market, then we take our profits out of a company like that and move them into another story that we see trading at a discount to the market with similar growth going forward.
But that's such a key point, as we both agreed, and as I say, it was a long time ago. I learned the hard way, by the way. I can give you stories that would probably have your hair drop out, and you got a nice head of hair. So some of these lessons are learned the hard way.
Learned the hard way in some stories. It's the best way to learn sometimes, right?
Yeah, to have... well, it certainly is painful enough. So I always ask myself, how many times do you have to learn the same mistake? I mean, I'm saying that to me, and that really encourages me not to do it again. And that's a great example, though, as you say, okay, I think the story's changed here. I don't like the valuation. I'm out. But does that mean you permanently take it off your chart, if you know what I mean? Or do you sort of start creating another entry point, a re-entry point, I guess?
Yeah, certainly no. And there have been situations in the past, too. I know this may sound counterintuitive, but you've sold, say, a position at $9, and then the company, you could buy in when it comes down to $7, but you could also go buy in when it went to $10 if the underlying business had grown so much that the fundamental cash flow, the cash flow that it was producing, and the point it was trading at in the market made it a bargain relative to its cash flow. So it all depends on, people always say, well, if it drops to 7, are you going to buy it? That's not necessarily so, because the fundamentals of the business could deteriorate to the point where it's not a good value then. But it could also increase to the point where at $8 or $10, a higher price, it actually offers value or more value in the market than it did when it was at a lower price. So it all is the underlying business and the fundamentals of and the cash flow and what multiple it is trading off of that, and if we see growth going forward. So we weigh all of those things when we look at a business. Every time we look at it, you look at it with fresh eyes. So you have to look at it like you never owned this stock before. It's up 25% or down 25%. Is it a good value based on its cash flow at that point and going forward? Not where you were before or where it's always where you're looking forward on the business.
Hey, Ryan, before I get to that gold stock I mentioned, I want to come back to something here just very quickly because I love it. I look forward to it when you guys do a full takedown on a certain sector of the stock market or a certain idea. And I just want to mention, you guys got a brand new report called the Breakthrough Turnaround Canadian Small Cap Report that I know you've got some new recommendations in it. You got 12 stocks, which I like about this. You're just monitoring them, but they may be on your list for buys. And I just wanted to mention that to people because I love that stuff.
Yeah, I mean, clients become a client to our Canadian growth stock research today, and I think you get that report for free. So it's about 80 pages, has 5 new recommendations in it, all across sectors. Some companies that either turned around into profitability or breaking through into profitability right now. Profits drive stock returns in the long term, and XPEL was actually a company 2 years ago that was featured in this report. So that's where it came from. So that's where you get that. Can I finish the thought on XPEL for a sec? I just got instant message saying, so what do I do with XPEL now from somebody online? We get instant feedback here, right? Our thoughts are up 500%. At 20 times next year's earnings, fair value gives us a $10 target, really. So we're still holding it here. We still think it offers some value. It can have volatility, but if we think it's worth $10 and it's trading around $8.55, we'd still hold it.
And I'll just talk about one here very quickly because it was kind of interesting. Paul Beatty, a friend of ours at BT Global's, had a lovely track record, great track record, and he was telling me about Viemed Healthcare, and I said, no, I like that stock. And then here I find Keystone Financial comes out and says, hey, buy it. And so that was one of my, the ones that I was so on board with, and it's been a great performer too.
Great business. In layman's terms, what the company does is places therapists in homes to treat patients with very sick lungs. Unfortunately, these patients are near their end of life. Often they're treating their primary disease as COPD. They have ventilations with a mask versus forcing them to be in a bed and incubated. It's a better quality of life and better cost for the healthcare system. The U.S. system needs to save money. Viemed helps them save money. It's just been a great growth story for us. It's trading around $8 right now. We talked about it on Money Talks at $5, recommended to clients at $3.85. The last quarter, 45% revenue growth again, guiding towards 41% next quarter. Company does not issue shares to buy this growth. It is all organic growth, which is great to see. We think it's trading still at reasonable valuations right now. We would have fair value beyond $10, and you're buying it at $8 right now, and that would be a relatively conservative. Cash in the bank, no real debt here. These are the type of situations that we continue to own and continue to buy into.
Now, I want to remind everyone that anytime you look at a stock or hear a recommendation, it might be real estate, it might be stocks, whatever, precious metals, you always talk to your financial advisor, see where it fits in your portfolio. You just look, it's a straightforward question. What risk am I taking? And that's what Ryan and Aaron Dunn do at Keystone Financial. They say, okay, this is a conservative stock, or this is aggressive growth, or this is a hybrid, this is a spec. And that's a real key to do before you jump in. But we've been watching this moving gold market, and I've only got about 2 minutes here. But tell me about Dynacor Gold Mines, which you guys have been talking about.
Yeah, I'm going to say gold mines on average have been terrible investments long term, so we tread very lightly here. Dynacor is a little bit different. What the company does is they are a miller, not a miner. They purchase ore from locally registered artisanal or small-scale miners in Peru, and then they process it at their facility. We like it because it doesn't have that mine-specific risk. Now, the company itself missed production targets for this first half of 2019, but the rising gold price provides the business with some tailwinds going into the second half. It's twofold. Number one, better margin potential, higher gold price, higher potential profit. Number two, and this is really key, it's more feedstock for its mill. With the higher price of gold, more small-scale miners are incentivized to mine. They will bring some more ore in, and they will process more gold in the second half of the year. In fact, the company is now forecasted just on October 15th, 45,000 ounces of gold. That would be 30% higher than its first half of this year. Around 89,000 ounces of gold we should see this year on an annualized basis. Stock trades at about 4.5 times cash flow, has 17 million Canadian in the bank. That's 45 cents per share. So 25% of its market cap is in cash. Pays a 2.2% dividend. There's no debt here. It's kind of a lower risk way to play the current movement in gold. If we see a continued movement in gold, it should be significantly more profitable in the second half of this year. So a little bit lower risk way than buying a junior mining company or even a junior producer at this stage.
And how would you, again, putting on your risk scale, is it a spec? Is it a aggressive growth? Where does it fit for you?
It would be more aggressive growth, yeah. It's anything that's in there related to the gold price. If gold were to come off, 10, 15%, this company can do everything right, but it's not as profitable. It doesn't get as much feedstock come in. So when you're tied to a commodity, we always have a spec or aggressive type recommendation on it.
Because I just want to mention to people, that's Keystone also does what I'd call conservative or solid conservative stocks. So just keep that in mind. Go to keystocks.com, look up all of this stuff. Great stuff with Ryan Irvine. Ryan, thanks so much for taking the time.
Great to be on. Thank you, Michael.